we want to preview some of our earnings, kind of hits and misses going into that season. But first, I want to kind of start at a 60,000 foot level, if I could, really kind of highlighting near and long-term sector preferences. Remind everybody of our key sector picks. Of course, it's always good and timely, and some key thematics in this space. So let me say, like I said, 60,000 foot view. 24 names across our coverage list, and Scotty and I have always said we broke them up into 4 different divisions. Namely medical devices, you have the healthcare facilities, the services, and biotechnology. Now, we do this because each of those different divisions carry different risk profiles, so all clients should be really cognizant of what you're going to buy, given those profiles. So across our space, I really highlighted for you, sorry, people I know are still on the line too, our key top picks are actually in the red, and they're mostly offshore medical device companies, and I think you just have lower risk across that space. Number one pick to stand out is ResMed still, as it kind of builds a IT infrastructure medical device name right there, mostly US-centric, as you know. And on the cross of smalls, we have Nanosonics and ProMedicus and Mach7, and I'll have Scotty run through those with you in a short spell. We're also waiting for pullbacks. I think this is the most actually pullbacks or kind of stretch valuations I've seen across our space for a while now. And those are highlighted in green for you, the people that actually can see the slide deck. So that's CSL. Obviously a really good core operator, and we think it's a key portfolio holding across anyone's portfolio, but it's facing near-term headwinds, numerous headwinds, and I'll get to that in a second. But we like the stock below 270. I'm going to just kind of flag to you for where we're going to like to pick these names up. For Cochlear, it's the same kind of boat. It's a really stretched valuation. We like the stock below 170. So it's 270 for CSL, 170 for Cochlear. Ramsey, we also like. It's the largest private hospital operator. I'm sure I don't have to tell you guys that. We like the stock closer to $55. If you can pick it up there, that's good buying. And I'll lastly point out diagnostic testing company Sonic, which we recently moved back to a neutral rating. It's kind of run right through our price target as well. We like that closer to $27. So looking to sector performance, it's really been a bit of a mixed bag, and you can see on the left side, people that can see the slide, sorry, people on the line once again, you can see where the sectors kind of outperformed or underperformed. The two biggies, the CSLs and ResMed, shot the lights out. We also have a quasi name I always talk about, Ansell, which is in the personal protection equipment space. Actually, it's an industrial name, not healthcare name, but it kind of gets a rating in our space. Really propped up that sector over the last year. 8 points outperformance over the last year across the broader versus the broader market. But that's contrasted by the aged care providers. Now that is Regis and Japara really took it on the chin, down over 50%. That's really with the regulatory risk with the current ongoing Royal Commission that should report out. I believe the report's coming out in November. And really soft occupancy across that space we're seeing. But over the last 6 months, the COVID pandemic obviously hit every sector, and healthcare included. However, we did better. We held up, as you would expect, it being it's a defensive space, only down 8.5%, better than the overall market. We're down 15%. As you said, you would expect for a more defensive space. But looking over the 3 months, I really want to point out the near term, what's going on. Obviously, the sectors underperformed the market by 11 points, so considerably underperformance, mainly due to CSL's weakness. You can see on that chart that CSL underperformed by almost 11%, really masking really strong gains from the COVID-19 really focused companies. And that's mainly the Ansells, as I said, and personal protective equipment. That's up 35%. And we have the diagnostic testing companies, that's Sonic Healthcare and Helios, and they're both about putting up 30% well. But taking a step back and looking on the right side of that chart, so I really want to put this slide up, and I put it up before numerous times, showing the 10-year returns across healthcare versus the ASX 200. It's really outperformed the market 80% of the time. So 8 out of 10 times you can count on healthcare to come in quite strongly. Really, that's underpinned by really strong sector growth, really strong fundamentals across healthcare, as you guys realize. But volatility is definitely going to tick up. I have on the bottom of that slide, what's keeping people up at night. Obviously, COVID-19 ad nauseum. We have 0 to negative interest rates. We have unprecedented monetary stimulus. We have fiscal extension coming in the U.S. as well. And let's throw into the mix geopolitical concerns overnight as well with what's going on with China and the U.S. and trade secrets. So definitely a stock picker's market, I would say. I think that's probably across the rest of the market. It doesn't include my sector specifically. Okay, but let's currently look at over what's happened. Sorry, in the near term, you have to be very cognizant of valuation in my space. It's rich at the best at times. It's still trading. You see on the chart on the left, that's a standard deviation. Those lines, it's one standard deviation rich, or more so, I would say. Really, the most overvalued stock across my space is, lo and behold, Cochlear. It's up, it's trading at 59 times forward earnings. Really nosebleed levels for Cochlear. But most undervalued, we have Regis Healthcare at 12 times, and really Japara a little under 1 time. Looks on the less expensive side. But I really want to point on the slide on the right, that the healthcare overall represents about, let's call it 14% of the ASX 200. Now that's considerably higher than what we've seen in normal years. I have over there 500 points in the last year. That's really getting up, and I always preach up here saying that a lot of our clients' portfolios are underweight healthcare, and the MSCI index would normally have healthcare at about 15%. So we're stepping very close to that. So once again, I'll reach out to the network saying if your clients are in roughly 15% healthcare across their portfolios, you should kind of ask them or help them out in that regard. I won't go through the specifics there, but just talking about the fundamentals, really good, strong earnings CAGR over the next 3 years. Sorry, getting some feedback. Sorry if I didn't mute your line. It'd be great. The fundamentals over the next 3 years, I was saying, for the space look really quite strong. With the healthcare space up over 10% CAGR, actually blowing away the rest of the industries. So let me jump into reporting season real quick, and heading into that, the key themes we're looking for. Sorry, a little bit of feedback as well. If anyone has their line, please mute. Just the dividends I wanted to point out in this space. Really, healthcare, a lot of the growth, it's a growth space, so a lot of these companies do not give off healthy dividends. But right now we have Monash, and Virtus Healthcare putting up 4 to 5% earnings yields. That's quite healthy, and EBOS as well. I would say that 3 to 4%. That looks really quite attractive for us. And very interesting, I think, for clients. A must-owns I have on this list, and I just pointed out a lot of these companies have run really strongly and some face headwinds. These are must-owns, good portfolio companies, but just not right now. Those are the CSLs. We have Cochlear, we have Ramsey, and we have Sonic Healthcare in that bucket. Catalyst-driven names we point out on the smalls. We have medicinal cannabis company, MDC, for clinical data readouts coming up. We have MicroX as the sales momentum, so look out for those two names. Stocks to trim, Ansell, like I said. Sorry, a little bit of feedback. Sorry if you guys wouldn't mind muting your lines. Stocks to trim, I was saying, Ansell, it's an industrial name masquerading as a healthcare name. So normally garners a higher multiple for that, but it's trading at 20 times forward earnings. Yes, it's a loved company because it's a personal protective equipment company, and it's leveraged to the industrial cycle. And if both of those are going positively, you can imagine what that is, but it's just a little frothy for us here. So I would be trimming Ansell. Helios as well recently sold its medical center business, jettisoning those, but now it's turning itself into a day hospital, quasi-pathology company. Not really sure what the future holds for Helios, so I'm more trimming Helios as well. Best emerging names I want to throw up there quickly. We have Mach 7 in the medical imaging space. Always a sweet spot right there with a lot more happening in that space. And we have Volpara, which the network should know very well, in breast imaging software, and are going from win to win. So reporting season. Let me jump into the nitty-gritty now. Obviously, reporting season is going to be a messy, messy time. I'm not telling anyone anything unusual. These numbers are kind of all over the place. There's huge dispersions amongst the analysts. I think Andrew pointed it out the other day to us. So it's very hard to pin these companies down on what's going to happen. But it's interesting because when we put the slide deck together, I was thinking, geez, there's a lot more downside risk I see from my universe than upside potential, normally across the large caps. So let me walk through, as I said, of course, the largest ones, CSL, arguably the best operator across my space, arguably the best across the ASX. I can make a point of that. And it should be in everyone's portfolio. Just not right now. I think it's more of a trim candidate, looking to pick this up, as I said, around 270. Ironically, what's happening now in the healthcare crisis for COVID-19, it's more of a headwind for CSL, not a tailwind, which people kind of think, well, what's going on? Well, remember that CSL gets the majority of its product from plasma donations, mostly in the United States, which are paid donations, right? So right now, unfortunately, a lot of the donors are locked down. A lot of the donors are in fear. A lot of the donors are not giving plasma. And unfortunately, right now, CSL, or for CSL's collection centers, they have over 300 in the United States. About 40% are in the southeast to southwest parts of the United States. And those, unfortunately, those states, namely like Texas and Arizona into Florida, you've been hearing them pop up on the news for a good reason. They're really, really spiking as far as COVID-19 deaths and as far as infection rates as well. So that's keeping people out of giving plasma. Plasma centers are open in the States, however, very, very low volume. So that's definitely going to be a headwind for CSL. Now we add into that, we have increasing costs to get those donors into those centers. So they're spending more in SG&A dollars to try to convince people everything's fine. But to do social distancing mandates and measures, they're going to have to increase their costs to make sure people are spaced out in the collection centers as well. And I also saw overnight that the wonderful tropical storms had started in the Gulf of Mexico, and I don't know if anyone caught it overnight. Tropical Storm Hannah, or a Hurricane Hannah, was downgraded to a tropical storm, had hit southern Texas. That's also not a positive for CSL, with 13% of their collection centers are in the state of Texas. So what do you do with CSL? Like I said, I'm more trimming it, and I've always said, I think for the last couple of months, I'm buying this thing at $270. Everyone should own this thing. It's a great company. You could get your chance now as this thing kind of rolls over. I think consensus estimates coming for this year at 12.5% growth. I'm sitting at 7.5% growth. Could come at 8 to 10. It's really hard to know, but if it pulls back, I'll be buying CSL 270. Keep that in your head. Cochlear, let me jump quickly to Cochlear. We're expecting a soft result as well from them. Had an early May trading update. Sorry, didn't really paint too rosy of a picture, unfortunately, for that company. Once again, their main geographies, the United States. 50% of their sales emanate from that location. Arguably deteriorating, as I said, with COVID-19 cases increasing and reinstatement of lockdowns. If you look at the states, the COVID cases are running 65,000 plus a day. Put it in perspective for you, that's 40 to 50 cases every minute happening in the United States right now. Not that great. So look to buy Cochlear, as I said before, under 170 or below 170. And last, I'll leave you with Ramsay on my downside list. Obviously largest private hospital operator here domestically. Shares have struggled of late, and I've been more neutral on this name. There's different hot button issues. Affordability, we've always heard that's nothing new. Toing and froing with the health insurers, that's nothing new. Looks really to move outside of the hospital walls with its strategy. That's something that's really got to be flushed out with what's going to happen. What's the new Ramsay look like? Because it is changing its stripes a little bit, and that's a little bit of a worry to me. And of course, COVID-19 to us is a double-edged sword. While it does provide cost recovery and revenue guarantees for this hospital operator, it really stagnates its profitability or does not allow profitable growth because the hospitals have to maintain full staffing levels according to their mandates. So it can't flex its cost base at all. So it's barely washing its face or just washing its face. We like to name closer to 155. So let me stop there with my coverage list. And let's move up to Scotty and kind of walk through some of the kind of his key picks and the smalls, as well as kind of hits and misses leading into earnings season. Scott, you there?
Yeah, thanks, Derek. So I'll quickly point out Nanosonics. We moved to an ad recommendation last Friday. Although we have it in our downside risk category, it's really a company we want to be on the positive side of. So we do expect that potentially there could be some weakness at this August result. And if we're right there, we're certainly going to go all boots in on Nanosonics. We think long term or even medium term, it's a great story in this high-level disinfection area. Also, just quickly point out, Derek's mentioned the dividend payers, Monash and Virtus. So they had deferred their dividend from interim. If we look at just paying that at the final, which they will do, they're yielding around 4%. Share price hasn't moved too much. That's a good opportunity for clients. And finally, just Max 7. We know this story well. We've raised money for them. They'll come out with a positive EBITDA number for FY20. The key catalyst moving forward for them is the contract wins, which we're expecting over the next couple of months.